We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from olivermsa.com. Thanks for joining me today, Michael.
Oh, great to be here.
So you've developed a very technical way of looking at the individual markets, but have been saying that there are many markets that have become much more correlated. And I wanted to ask you if we'll start to see a violent rebalance in many of these markets. And what are some of the broader market conditions that you're paying attention to here?
Well, I suspect over history, there's been linkages and dislinkages between the asset categories. For instance, in the 70s, the stock market had a big drop in the 1974 and then a rebound into 77 after that big bear market. But then it went basically sideways for 5 years, oscillated up and down. I'm talking the S&P now. But during that time, investors allocated their assets to commodities, especially starting in with the gold low in 1976 and the commodity low in 1977. And they had enormous bull trends with inflation and rising interest rates to reflect that inflation. And commodities exploded and stocks went to zero. It was a total wasteland. A lot of teasing rallies and teasing sell-offs, but it didn't go anywhere. Commodities took control. So we think we're in that situation again. It's been subtle over the last year or so where we've seen improvement and basing action in most commodities, which got whacked, just like gold did, between 2011 and 2015 and 16, when most commodities dropped coincident with gold. Then gold turned up and most commodities just continued sideways, basing. Soybeans were boring, corn was boring, et cetera, et cetera. And now in unison, we've seen the subsectors within the commodity category turn up. It's not like each one of them found a good selective fundamental within their own category to use as an excuse for the upturn. Mm-hmm. I think it's simply monetary policy. And investors, even non-gold bug type investment managers like Ray Dalio, for example, who about a month or two ago came out and warned people, he says, listen, folks, quit looking at your stock prices. It's becoming meaningless because the money supply is exploding off the page. And therefore the money unit, the degradation in the value of the money unit is smoking you in terms of what you think your stock is worth, considering the devaluation in the money unit. And we're not talking now dollar versus euro or anything like that, but just simply the expansion in the supply of the money units. Never been seen like this before. And gold knew it all along. Gold's been going up since its low in 2015. It made a secondary low in 2018, which was about $100 off the low of 2015. So it came back and sort of retested it. But since mid-2018, gold's gone from $1,160 to $2,000, and it did it without any assistance during most of that trip from a weak stock market or from strong commodity prices or from a strong dollar. Those didn't exist. It just anticipated what was likely to occur. And sure enough, it's occurring. And now the commodities are tailing gold up, which I think is wind at the back of gold. And the dollar is turning down badly. Most all of our momentum-based long-term breakage numbers started to break in May of 2017 at price in 99 on the dollar index. It then dropped to 88 area shortly thereafter, then rebounded and confused people because dollar rallied, most latter half of 2018 up until March of 2020, didn't go back to the highs. And since it's collapsed back down near the 2018 lows, but all of our momentum metrics are broken. And the reverse is true with the euro and the yen, meaning they're up. And, it's one piece of crap, piece of paper against another. So it's really hard to make an argument that, dollars are less worthy than the euro because they're both fiat currencies. But, they shift in value. But I think investors, especially big fund investors, have been subtly moving assets out of one category and into another over the last year or so. And I think now the public is starting to become a little more aware of that.
And so that's part of what you're speaking about when you say a violent rebalancing could be occurring.
I think it will become that way. Yeah. In other words, it'll become more bleeding obvious to everybody due to the velocity, let's say, of certain markets in their turn. We're starting to see that. In fact, if you just go have your listeners go and flip up a chart of soybeans or corn, mm-hmm. a monthly chart, go back about 10 years or so. And just look what's happened in the last 3 months. It's not like we get a drought in the US, okay? They've exploded. And oil's come back nicely from, $10 to 50. And natural gas is turning, and copper's exploding. And, they're all getting violent on the upside. Silver, for example, silver's long been, since 2011 peak when silver was back near its 1980 price high, which was $49, collapsed down into the, 10, 15 area, the $15 area on silver when gold collapsed, but has underperformed gold vastly all during that time period. But the action since July in silver, for example, and we want to pound the table on silver, it was in the teens, came up to $19.48, which blew one of our annual momentum oscillators through a roof. Not price. Price wasn't breaking through any prior highs, but momentum was breaking through a massive 7-year wide ceiling, annual momentum. And we put out a buy signal. Well, 3 weeks later, it was almost $30. Now, that's the kind of violence I'm talking about. And I suspect, and we haven't seen it yet, that there's going to be a point where gold is going to produce a tantrum like that as well. Because the gold move so far since 2018 low in the 1100s, there have been some strong moments, but nothing you would consider, violent or totally surprising, like that silver move this July, at 50% in 3 weeks. I suspect gold is about to produce one of those. And it wouldn't shock me that it's coming soon, like this month, maybe next month. And, one of the charts I sent you was a gold, very simple charts, pair of charts, in fact. There's a gold monthly price chart where you see the closes, it's connect the dot type thing. That's something everybody sees, monthly price of gold. And you can see the basing action. It's occurred there since even in 2013, you got down near 1,200. You finally got down under 1,100. But during that time, the chart below it is a very simple chart. Let me explain how we plot that. It's where those monthly closes are in their relationship to the changing 36-month average, 36-month average being a smooth 3-year average, okay? Mm-hmm. So we simply oscillate the price of gold in relation to that mean. And as it happened, you look at the bottom chart, there's this cluster of horizontal ink that prevailed from 2013 through late 2015, well below the zero line, meaning well below the 36-month average. And in February of 2016, as the price of gold reached above 1,140, which is about $90 off the price low, you blew through a multi-year top that you could see very clearly on that momentum chart, the first red line. And gold went from the 1100s up into the mid 1300s rapidly. It was like, I'm alive, okay? I'm here. And then you wallowed around above the lows in price. You never went back to the lows. And momentum wallowed around sideways, well above its breakout level, which had occurred again in February 2016 when we first put out our first major long-term don't get out buy signal, 1140. And then momentum built another horizontal structure above the zero line, meaning every time you get up to about, you can see on that chart, the bottom chart there's another red line. It's about 10% over the zero line. You get up there, you bump it, you fall back down, you bump it, you fall back down. But it created what we call a structure, something very clear. And in the summer of 2019, when gold itself went up through the mid 1300s, which had been sort of its top of its base, annual momentum broke out again. And so we issued a second buy signal. Well, here we are, we're now at 1900. And, there have been many scary points on the way up that many technical analysts have described as a top, get out, and so forth. And we've not seen anything in our long-term work, if you look at that bottom chart, that broke anything. Just going up. Yeah, there were some sideways movements, some downticks and so forth, but any downside didn't break anything structurally speaking on the momentum charts, not even on the price chart, really. So we're very content with our bullish outlook on gold, and we think that probably the next set of charts makes our point here. It's just a simple price chart. It's a bar chart of gold. Each year is one bar. And we start back in 1971. And recall, gold was legalized in the U.S. for trading in 1975. As it happened, there was a bull market already underway in the cash market from the early 1970s down around $30 an ounce. It got up to $200 by the time they opened trading on the COMEX in New York in January of 1975. So as soon as they opened the futures, you topped, okay? Just like Bitcoin did back in late 2017. Anyway, but that move, that first bull market in gold, that Americans got to see because the market opened in the US at the top of that market was a move from $30 to 1975 high of 200. That's like a sevenfold gain, 7 times, sevenfold. Okay. And then gold went down for a couple of years from its 200 high, went down to a 50% drop, went down to 103. And I happened to be actually standing outside the pit the day that low occurred. I think it was $103.60. There was almost nobody in the pit. Most of the floor brokers who had endorsed and welcomed the oncoming of the new gold futures contract were met with a bear market as soon as it opened, at 200 and went down for the next year and a half. And so the volume and the public participation and the excitement diminished. And so I think there were 2 guys in the pit the day that occurred, that low occurred. And anyway, it was $103. Okay, so now your second bull market there, marked by number 2, took you where? $850. It took it, several years, 4 or 5 years. But again, that's an eightfold move. Mm-hmm. Okay. So forget the price dimensions here. Think in terms of eightfold, sevenfold, so forth. Think in logarithmic terms. Okay. Then gold went down and went sideways for a long time. Basically, anything above 200 and get back above 400, but basically in a box, nowhere land. But then in 2000, basically when the stock market was topping, by the way, gold bottomed, turned up. And by 2011, we were at 1920. As an intra month high, at least, to close that year below 1600. But still, that move, that number 3 move, was what? An eightfold move. Mm-hmm. Starting to get a message here. Okay. Then we have a multi-year drop, which MSA was fully bearish in 2012 at around 1650 to 1700. We stayed bearish. Finally, gold collapsed in 2013 in the spring. In other words, it wallowed around up there near the highs, and everybody thought it was just congestion before you went for more, but it wasn't. It was a top. Mm-hmm. And that collapsed down to just above 1,000. Nice drop, almost a 50% drop. And then you labored for several years above that low and finally took off again. Now you went to new highs last year, had a good, strong yearly close, good, strong yearly high. The bar looks great on the price chart. Should. Looks fine. Annual momentum says everything's fine. But that move so far is only a double. When you go from the bear market low, which was 1054 in late 2015. Well, it's not unreasonable in our view, when we look at a lot of our long-term momentum charts, to assume that this move could easily be another eightfold. Mm-hmm. We have no argument against it. Everything says fine, the door's open, and this bull market is not old. I mean, really, when you look at the price chart, it only emerged above the top end of the basing action that occurred from, 2015, 16, 17, 18. When it got up into the high 1300s, it broke out on price. It's sort of fresh. It's not an old guy. And we see no reason to not expect gold to approach 10,000 from the underside, or eightfold. You want to do that to 8,000. Okay. These numbers sound ludicrous, but they're no more ludicrous than the ratio moves that occurred in those prior 3 bull markets. Now, we also happen to think that while gold does this, gold's the mama of the monetary metals. Silver's the baby. Gold miners are somewhat, the wild children of the gold market too. They oscillate violently, but we think that silver is now poised because of our technical analysis of its relationship to gold on a ratio basis, a spread basis. In July, when silver broke out on our annual momentum, so did its spread versus gold, meaning it shifted from underperformer to outperformer. And I think that will continue during the rest of this monetary bull market. I have an expectation that the way things look on macro technicals of many markets, foreign exchange, commodity situation, the pending stock market vulnerability, we'll get into that in a minute, mm-hmm. that this bull market in gold is likely to come and go much more quickly than some of the prior ones. In other words, rather than incremental, which a lot of people are used to incremental trends, once you get going, you go at the same angle and all that stuff, that we could go chaos theory and go into a very rapid upside so that we could get to maybe that 8,000 gold by late this year, early next year. Would not surprise us at all. So where would that leave silver? Well, in our opinion, you could see silver over $200 an ounce. So if gold goes up another, 4 or 5-fold from where it is now, or 8-fold from its low, we think silver could easily go 10-fold from where it is now in the high 20s.
And is that on the same timeline?
Same timeline. Silver will move with gold. The issue is the percentage gain. While gold's making 10%, silver makes 20 or 30, Mm-hmm. And you see that often day-to-day action even, over since the end of last year to the high we made today in these markets. Gold went up, a nice good single-digit percent, but silver went up almost, $1.50. on a percent basis, much more than gold. And we think that ratio will continue and that silver will be a better place to be than gold on a percentage basis over the next year or so. And they're leaders. They went out front well before the commodity, quote, inflation even began.
Sorry, Michael, but before we continue too much there, when you're looking at momentum, as you're talking about momentum instead of price, can you just remind our listeners exactly what you're looking at there?
Well, you're measuring something against a mean or an average that market itself set up, meaning the pace of which the market advances and that moving average advances is established not by the changes in the money unit that you're measuring by, the dollar or the euro or the yen, which are constantly changing in value, generally down in terms of real buying power. Why? Because the quantity is increasing. Instead, we try to distance ourselves from that price-based analysis because we know that the monetary unit itself is a distorting yardstick. It's like, if you literally had a yardstick and we're building something, a house, let's say, take you 6 months to do it, and your yardstick changed its dimensions, every month or so by an inch or two, but it still said 36 inches, you would end up with a pretty unstable house at the end. Okay.
Yeah. So you're just really trying to take a more objective measure and look at what's actually happening in these markets.
Yeah. The mean is, it's also an effect of the currency, but it's more of an effect. The change in that mean, that rising 36-month average or falling average, whatever the case may be, is more determined by the action of the underlying asset. And so we measure against the mean, not against the nominal value measured by the money unit. So when we measure things that way, we oscillate them on an oscillator, and you get a different technical picture sometimes, as you can see in these charts. I mean, the price chart looks one way, and you look at the momentum charts. Oh, wow, that's clear. There's a ceiling here, or there's a trend line that isn't otherwise visible on the price chart.
Yeah.
So that's where we focus.
So do you ever take into consideration these long-term cyclical trends for the metals?
No, I don't agree with the cyclical notions that, like at a certain month of the year, gold's going to be weak or strong or that kind of thing. It used to be in the old days before, for instance, grains. It makes sense in grains that there's cycles because there's growing cycles. But once the world began to produce the grains universally, more in equality, Brazil produces it, we produce it, soybeans, Russia produces wheat. And it balanced out worldwide such that the cyclicality or the seasonality in grains even was lost because it was grown globally at different times of the year. Well, I never bought into the notion of seasonals or cycles in gold. We look at the momentum trends and we don't factor in the notion of cycles.
So you're aiming for, let's say, this new high in gold to be achieved somewhere within the next year to year and a half. Would that be accurate?
That'd be accurate. Yeah, that's my guess right now. And if I'm wrong, I don't think I'll be wrong on the direction. The only issue might be the timing. But I think that the whirlwind of events that we're seeing, which MSA anticipated over a year ago, in fact, we use terms like secession, abolition of student loans, Trump will lose, et cetera. We could anticipate that even before the coronavirus because of the long-term momentum trend structures that we saw in too many asset categories looked terrible, or they looked great, meaning we were going to see major shifts in these asset categories, probably with some unison, not month to month, but maybe year to year. We'd see some uniformity in the shifts. And when you have shifts like that, especially that you detect not on week-to-week action or month-to-month, but on annual momentum, that's usually significant. In other words, it means something's going on out there. And it isn't just whether they're getting enough rain on the soybeans. It's a bigger factor. And now we're starting to see it on the headlines in the daily news. There's growing chaos, not just politically. It's not just issues of policemen shooting Black people and their justified, demonstrations against. It's now spreading. It's on all sides of the equation. Look at what's going on right now in Washington, for example. So this kind of chaos was sort of built into the cake in terms of what the momentum chart said was likely to unfold, namely rapid, dramatic trend changes. And I think the one right now that is the most delusional or giving the false information is the U.S. stock market. It's probably one with great vulnerability on the downside again. And we called the crash in February of last year. We said this is going to crash, and it crashed. Got within about 90 points of our target low. And one day off the low, we said, if you're short, you better cover. And we didn't know it would go to a new high, but we knew something big on the upside would occur. And it did. and it went to a new high. Now, most people looking at the stock market, for example, they're no doubt saying to themselves, hey, the Fed printing all this money, they got our back. And all we can say is historically, that's been true at times and totally untrue at times. Where there are times when the Fed had the back of the market and the market collapsed anyway. Take 2008 to 2009, for example. So we think right now, if you're in the stock market, first off, take a look around at the developed economies of the world. Let's say the Euro Stocks 50 index, the blue chips of Europe, or look at the Nikkei. You do not see the kind of price behavior there that you see in the chest beating of the NASDAQ 100, for example, or in the price chart chest beating even of the S&P.
Do you see a risk of another big crash like we had in March coming for the general stock market? And maybe what role could the 6 biggest stocks in, let's say, the NASDAQ 100 have in that, for example?
That's exactly, you nailed it, Tom. The narrowness of the leadership is bleeding obvious. I think most analysts recognize that. And we've even narrowed it down further. Starting probably about 3 or 4 months ago, we said, don't focus on all these other subsectors of the market. In fact, some of them are very anemic. If you look at the banking sector, Bank BKX index or KBE ETF of the banks, they don't look anything like the S&P. They're not back at new highs. They're very anemic compared to the S&P. But when you go down to the top 6, you said, well, we go down to Microsoft, Apple, Amazon, and of course, Google is also in there. There's 2 Googles. There's the A and B, the Google with the L and not the L, that comprise about 50% of the weighting of the NASDAQ 100. So like 5 or 6 symbols, you said, that are at the front end of the market. And that's why the NASDAQ 100 looks like it's in its own world compared to, let's say, even the Dow. It's gone ballistic. The NASDAQ 100 has produced what we define as a blow-off. Blow-off means you get a strong trend and then suddenly you accelerate just vertically. That began this summer. And since then, we think we're topping out. And we've got some numbers that we give our subscribers that are adjusted monthly that will define the point at which the NASDAQ 100 aborts that blow-off phase and goes into a decline. As far as market crashes go, and also in that regard, we're eyeballing Microsoft, Amazon, and Apple, because we think when those 3 go, the world goes, okay? Now, I don't think we're wrong on that. We'll find out. So our focus is very narrow because we think the leadership is narrow. As far as crash issue goes, I'm not sure. Sharp decline probably in any market that's been in a blow-off, as NASDAQ 100 has been. Microsoft, Amazon, and Apple, for example. Their declines could be very sharp percentage declines if they trigger our numbers, and we have specific numbers that are below the market, not all that far below, that those declines could be crash-like in the speed and dimensionality. But we suspect that the S&P, which is not so reflective of that blow-off type action, or the Dow, or some other sectors that have not made new highs, that their decline, while in sync with a NASDAQ 100 implosion, will not be crash-like. Whereas the NASDAQ will take leadership on the downside on a percent basis, just like it has on the upside. But it doesn't mean the rest of the market has to crash, just will go down with it at some lesser percent gradient. And so I'm not sure about making an argument for stock market crash, but another bear market, yes. But we're very number oriented and structure oriented. So we've not triggered the structures on NASDAQ 100 or on those 3 symbols, or we call them the 3 leaders. But those numbers are not far below on a percent basis. And it's not a time, if you're bullish on the market, to applaud a pause. Pausing is not allowed now because the numbers that break the market are rising with the upward adjustment in our long-term moving averages.
So, Michael, before the call, you and I were discussing a little bit about how the mining stocks probably will not be linked to that, let's say, general market crash if and when that happens this time. So tell us a bit more about why you think that change has occurred.
Well, first off, the gold miners on a fundamental basis, and we're not into the fundamentals of specific miners. We evaluate the mining sector. We evaluate symbols within the sector looking for the outperformers. Just like in any sector, there's going to be better performers than there are, and there's underperformers in any given sector at any given time. So we technically come up with those decisions. But when we do relative performance analysis of gold miners versus gold, they, like silver, underperform gold from the 2011 high through the 2016 area. But in recent months, the gold mining ETFs and sector indexes like XAU, for example, have shifted enough for us to label them moderate outperformers to gold. And this is a technical assessment, not a fundamental one. And we could easily see them going to full outperform. We've got specific numbers that would define that level. So we think that over the next year or so, it's highly likely that gold miners in general, as a category, will outpace gold on a percent basis. We think they're a better place to be. Yes, they do act like wild children on a leash. When gold goes down, they go down bigger. When gold goes up, they go up bigger. But net on balance, we think they will outperform gold, just like silver will. And then there's symbols within each in the gold mining area that will do better than the gold mining area itself. And one of those, for example, we think that, for example, is an ETF called SIL, which is silver miners.
SIL, yep.
Yeah, we think it'll beat GDX, for example. In other words, the silver miners look technically poised to outperform the gold miners. Just like silver, we think, is undervalued in relation to gold and will outperform it. So yeah, we think that's the case. So if you're in the monetary metal bull market, use gold as your mama. It's the leader of the pack, and we declare it to be fully bullish. No technical vulnerability that we see right now. We think we've only gone through a scary corrective pause process, really, since the August high that spooked a lot of people out of the market. And I bet they regret they got out, especially after what's happened in the last few weeks. But we think the leadership will be in the tail end, what's been the tail end, and that's the gold miners, silver miners, and silver in relation to the mama gold.
Mm-hmm. So, Michael, as we were talking about the US dollar, and you were saying that it's broken below any real definable structure, are you able to really make any kind of picture as to what could be ahead for the US dollar going forward here in 2021?
As far as ultimate low, no ultimate. I know some guys are out there that are mega bearish, think it'll go off the page, and I don't disagree. If you look at gold trends since the 1970s, just punch up a chart on the dollar index, for example, and go back, 50 years as far as you can go. You'll see that most of its trends don't last a year or two. They last a decade or so. Mm-hmm. When it turns trend, it tends to turn trend for quite a while. So our first sell signal on the dollar index was at a price of 99. This is back in May of 2017, and it dropped about 10 and a half points immediately after that, down to 88 and change. And then it turned back up and spent 2018, 19, and into March of last year, trying to get back to the high, couldn't quite make it, and it collapsed back down. Now we're in the 89s again. Mm-hmm. Well, in that process of topping, again, its trends last a long time, so its tops and bottoms take a while to fully develop. Mm-hmm. It has blown every long-term momentum trend structure that we can come up with. 3-year average momentum, 10-year average momentum is broken. And now, even if you just plot a simple price chart and go back a decade or more on the dollar index, you can see that in July of this year, last year, you broke a multi-year, very clear, very simple uptrend structure. It was lagged in terms of its downside breakage to all the momentum indicators, but still it validated them. Mm-hmm. There's only one level below right now that, the price chart guys are looking at. And that was probably that intra-month low that occurred in, I think it was February of 2018 at 88.25. Well, the dollar index is trading about a point above there right now and has not yet taken out that last major pivotal price low. It has taken out the major uptrend. Momentum has taken out that low, but price chart itself hasn't quite nipped out that low. Once you take out that 88 and a quarter low on cash dollar index, even the price guys have to at that point say, oh, golly, it's going down. We suspect there might be support in the mid to low 80s, temporary. But again, when dollar trends shift, they go big, and the old low at 70 area, which was the low of a decade and 15 years ago, we suspect that'll come out. Beyond there, I'm not sure.
Interesting. So where do T-bonds fit into this picture? Are we likely to see an upward stab in price before more of a long-term downtrend?
Well, there's T-bonds and there's T-notes. And bonds, of course, 30-year. And most people are looking at government debt instruments like the JGBs, Japanese government bonds, which are 10-year, the German Bunds, which are 10-year, and the U.S. T-note futures, which are 10-year. And while we suspect that sometime later this year, yields will begin to rise, prices fall in those markets, they simply don't look right now from a technical point of view to begin that process. If you look at a T-note futures market or T-note cash, whatever, since early last year, it's basically sideways with a slight downward drift, but a lot of months involved there with very little drop in price. It looks to us like on our momentum work and our price work suggests to us there could be one more upward spike in price. In other words, one more flight to safety. Well, what would that suggest? A flight out of stocks, probably, because that's what helped cause that sharp up move that we had into March of this year in the T-bonds and T-notes, was the flight out of stocks. So we suspect that if you're bearish on bonds and notes, don't be bearish right now. Give it a chance, because there could be one more upward spike that could hurt a lot if you're short. After that, different story.
So can both of these factors provide even more of a tailwind for the commodities in general? And have we broken out of some of the key trend lines in the Bloomberg Commodity Index?
Yeah, in fact, there's a set of charts I've given you that there's a Bloomberg Commodity Index monthly price bar chart going back a decade to 2010. And it's collapsed from the 170s down to the high 50s last year, okay? And we're now at 80. So percent-wise off the low, it's a pretty big move, okay? But nobody's noticing it because on a price chart, you can't quite make a bull case looking at that monthly price chart. But when we run our quarterly momentum, which is also a long-term metric, a long-term yardstick, quarterly momentum means we're measuring it against the 3-quarter moving average, which is like measuring something against a 200-day average or a 10-month average, something like that. It's fairly long-term. If you look at that momentum chart, you can see that since 2010, there was a 4-point downtrend line that you can't find it on the price chart that you broke through in August last year. That was in the low 70s on the Bloomberg Commodity Index. So that was the first breakout signal where we thought, okay, the commodity uprising is about to begin now, finally. And then in October, we blew through a flat ceiling on that momentum chart that we've shown with the red line there by trading a mere 10% over the 3-quarter average, over the zero line, blew through that entire ceiling. Now, if that bottom chart were a price chart, everybody in the world would be bullish on commodities, rampantly bullish, okay? But they're looking at the price chart. We think that the dollar index now above 80, these charts only go through the end of last year, end of December. We're now above 80. We suspect the dollar index on this surge that we're now involved in will reach 110 before it even pauses. That's not the end of the move. That's just like the first leg. Well, you do the ratio, 30 more points on top of 80 points. That's a heck of a percent move. If that surge occurs, which we think will occur, and we're getting validation of that through examining the commodities that comprise the Bloomberg Commodity Index, that's the kind of percent move that will really turn heads. And that's when investors will say, hey, look, these bubble stocks have been going up for 10, 11 years compared to these commodity-related stocks, like some of the oil subsectors or the XME ETF, the basic mining stocks, or anything commodity-related, fertilizer companies, for example, that have been beat off the page percent-wise over the last 5 years or so. That their chance of going up on a percent basis and a large percent basis, in contrast to a declining stock market, you're going to have money move. And we think this noise that's about to come from the Bloomberg Commodity Index will attract more and more money out of that one category into the other.
So, Michael, when you're swapping back and forth from, let's say, weekly to yearly charts, what are some of the differences that you're looking for and indicators that these charts really show you?
Well, we do look at, in our reports, we often will look at what we call intermediate trends that could be determined by a 3-month average momentum chart, not a 3-year average, for example, or even a 3-week average momentum study or a 10-week, something more close up, in other words. And we don't discount sometimes the significance of those trend changes, but you've got to realize in any large trend that may take 3 years or 10 years, you're going to have negative zigzags against that trend. If it's a bear trend, there were many, count the rallies that gold produced after its 2012, 2011 high, going from there down to 1054 price in 2015. The number of couple $100 rallies were stunning, a lot of them, but they were teasers. So you have to put into context, if you've got, let's say, a buy signal on a weekly momentum study, it says, hey, this market's going to go up, despite the fact that it's in a long-term downtrend. You have to put the two together and decide whether, okay, this upturn in the weekly studies is valid, but be careful because it's against the major trend, which is down. Now, when they both get in sync, all the better, because then you have all the pistons firing in the same direction. But you have to put into context that the weekly analysis and the 4 or 5 or 6 week rally or 6 week sell-off that you get, put it into the context of what is the larger trend, if there is one, on that given market, so you don't get confused by it.
So just to kind of wrap up the metals outlook here, what are some of the key levels that you're really looking for to, let's say, confirm this trend into this year?
Well, frankly, silver today, for example, price comes into focus for us. We tend to diminish it at tops and bottoms because generally a top or a bottom is first validated and developed by momentum action, not so evident on the price charts. Mm-hmm. But then once the trend gets in motion, the price action will tend to get into sync with, agreement with the momentum trend. And so, for example, now price of gold and the momentum of gold are in sync with each other. They weren't during the 2015, 16, 17, and 18 basing process. Price didn't look that good. Momentum already said, I'm good. Mm-hmm. Okay. But now they're in sync. And frankly, silver today traded over 28. Well, what does that mean? Well, point and figure charts. This is the guys that make the X and O charts, up ticks and down ticks. If you plotted silver on a $2 basis, every uptick you put in is a $2 uptick, $26, $28, $30, et cetera. Then the recent base breakout from the teens ran up to where? Not 30, didn't get to 30, stopped at 28. Then it pulled back where? You got 3 downticks to 22. That occurred a few months ago. Today, you got 3 upticks again. You're back on top tick. And not on the nominal price chart, which got to 29 and change, but on a $2 point and figure chart, for example, price of silver went back to top tick. You usually don't top a market by regaining the old high. So that's a comfortable tick for us on silver today by touching 28. And gold, no doubt, if it touches 2,000 again, when it does, people say, hey, we're back to 2,000 again. Golly, it wasn't a top after all.
Game on.
Yeah, you get my point. So in other words, if something's real high and you've fallen away from it, you don't go back to it again. Like in 2011, you hit 1920 gold. You never came back to 1900 again. You had repeated highs in 2012 that never could even get back to 1800.
So for some of our listeners, Michael, that want to look at these momentum indicators that you're talking about that are in sync with the price action of gold, is there anywhere to kind of see them, or is it your proprietary work?
It's proprietary, but on our website, www.olivermsa.com, there's a section called Method. And if you click on it, we show some reports and some charts and some history about how we do construct these things. And they're not typical kind of momentum indicators that most people are used to, like MACD or RSI. We don't tend to produce wet noodle indicators, meaning that loop up and loop down and loop. We're looking for structure and clarity, something to snap. In other words, not something like a wet noodle, but something when it breaks makes a noise. And by that we mean, when you look at our momentum charts, pretend they were a price chart, and you can see what we mean by a structure. Very clear multiple pivots that hit a given level or define a downtrend or an uptrend. And we look for structure because when structure is clear and it breaks, usually the first response is pretty rapid, because you move out of there pretty quickly. And that's what we like. That's what we want.
Yep, absolutely. Any concluding thoughts as we wrap up here, Michael?
No, I just think 2021 is going to be historic in a lot of ways, not just markets, but the markets will reflect and already are beginning to pre-reflect what we think is about to happen in terms of many notions turned upside down and assumptions turned upside down. And one of them you already mentioned is the relationship between gold miners and the stock market. That's one assumption we're going to see torn totally asunder, where miners go up and the stock market doesn't, okay? Despite the fact they're stocks. Got to remember back in 1929 through 1932, when the stock market collapsed, Homestake Mining, big gold mine back then, went vertical. Okay, so there's some history behind it too. But 2021 will be, we think, an historic year in many respects.
Excellent, Michael. Well, we'll look forward to having a couple more updates through this historic year, as you're calling it. Of course, we can find your work at olivermsa.com and Oliver_MSA on Twitter, correct?
That's correct.
Excellent, Michael. Thanks very much for your time today.
Thank you much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.